Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be talking about flows for the week ended Wednesday, December 3rd, 2014. We actually had the seventh consecutive week of inflows where we saw this week about $16.4 billion entered the conventional fund business. And this is after a shortened trading week that we had for Thanksgiving. And by the way, we did not produce last Wednesday, Thursday, Friday. So happy Thanksgiving to you all, and again, welcome back. But basically, on Friday, the day after Thanksgiving, we actually heard news over Thanksgiving holiday that OPEC had come out, basically said they're going to keep their oil production as status quo. I think it was 30 million barrels a day. And with that, everybody said, oh my goodness, the drop in oil is going to continue. We're going to have a slide in energy stocks, which we did. And Friday was kind of a lousy day. And actually, investors not only took that as a lousy day, but they turned Friday and then Monday into even lousier days after they heard Black Friday was a little bit of a disappointment. And also they heard during that time period as well that China and actually Japan had some dour news as well. It turns out Moody's downgraded Japan debt to just a lower grade. Basically, they came in from A3 to A1. Not a big drop, but enough to concern the markets that things weren't all as rosy as could be. And then to top it off, then the next 2 days we actually had great news as far as employment numbers came out. They had private sector numbers come out at the time, and they were over 200,000, and people were saying, hey, not too hot, not too cold. So basically they bid the Dow and the S&P up to new highs again and on record standings. So we really had kind of a mix and a roller coaster ride of a week. Well, let's see how those news panned out and played into the fund flows for the week as well. So let's go ahead and take a look at our macro groups. Equity funds, though, lost money, about $4.3 billion. That turned out to be actually a record amount. We'll talk about that a little bit later. Taxable bond funds took in about $1.6 billion. Muni bond funds took in about $200 million. And money market funds saw the lion's share of net new money come into their coffers. And that makes sense. As investors were saying, maybe this is a little bit longer. I think we're in our fifth or sixth week as far as rally goes for the S&P and the Dow. People are kind of saying, listen, even though we expect maybe a Santa Claus rally, maybe it's time to take some of those hard-won profits off the table and put those back to work someplace, or maybe in a safe spot like money market funds. $19 billion net new money coming into there. Well, let's take a look how that panned out on our individual breakouts. Let's take a look at equity funds first. For equity funds, we saw that they actually had a first week in 7 of negative returns, 0.56. Remember, I told you there was a huge meltdown during the week, but basically we got a lot of that back on Monday, Tuesday, Wednesday, but wasn't enough to turn us positive, about 0.56% as far as the loss. We saw $4.3 billion in outflows. This is the second consecutive week we've seen outflows. And how that planned out, we had domestic equity funds losing $3.4 billion. That's the 5th week in 6 we've seen outflows, but let me tell you here, it was the largest that we've seen since December 18th, 2013. So really, it was quite a downfall. Now, if we break this out a little bit farther and take a look at the non-domestic and domestic side, so we saw that domestic funds saw about $3.4 billion in outflows. Non-domestic funds did not get beat all that bad. And again, remember I told you China and Japan had some discouraging news. Well, domestic basically lost all the money. Non-domestic funds only saw about 0.9 or $900 million in outflows. It's the 4th consecutive week they've seen outflows. How we break this out, though, in a little bit more detail, large cap funds and small cap funds took it on the chin. Large cap funds lost about $1.8 billion. Small cap funds lost about 0.6 or $600 million. And when we take a look at the non-domestic side, we see international equity funds actually got a 1-2 punch. They lost about 0.8 or $800 million. But we saw emerging market, Japan, Pacific ex-Japan, and Pacific region funds all taking a little bit of money, not much, about $75 million, but still they were on the positive side. So a little bit of a head scratcher. Let's see what our ETF counterparts did. Qualified investors, authorized investors, basically for the 6th consecutive week, put money back to work into ETFs. So about $5.9 billion flow into that group. Spider S&P 500 was at the top, as it has been over the last several weeks. About $1 billion in net new money coming into theirs. But interesting enough, remember we had this just disappointing, if you will, oil shock. Barrel, $66 a barrel, for oil. Well, basically that just popped back up on Tuesday and Wednesday, and we see that it was one of the big purchases. Energy Select Sector Spider took in about $700 million, and then we see Technologies, which also was on the slide, actually lose some money as well, are taking money as well, and they took in about $400 million. On the bottom of that slide, we basically see the Spider retail ETF losing about $300 million. Remember I said we had disappointing Black Friday, and so retailers got punished for that. Well, now let's take a look at what happened to our fixed income universe as far as net flows went. 17th consecutive week we've seen inflows, this time to the tune of $1.6 billion. It's the first week in 7, however, that we saw negative returns, about 0.27%. So not a lot to write home about, but certainly there was some negative numbers and still positive flows. Interestingly, though, people went for the intermediate investment grade area, so corporate intermediate investment grade debt. So about $1.6 billion of net new money come in. It's the 31st consecutive week that they've seen inflows. A high yield, though, along with the equities, took it on the chin. They saw about $600 million in outflows, and this is the second consecutive week that they've seen outflows. Interestingly, though, we've talked about this before, loan participation funds or bank rate loan funds actually are included in the corporate investment grade debt funds. I took a look, pulled them out. They had actually outflows for the 21st consecutive week, losing about $500 million. So investors still are not feeling the pressure of interest rate increases, and they've walked away from those adjustable rate type of funds. Now let's take a look on the ETF side, what happened to ETFs. Basically, we saw an outflow of about $400 million. It's the second week in 3 that they actually seen outflows. And at the top of the group, as far as taking in money, we saw the iShares 20 plus Treasury bond ETF take in about $300 million. And then at the bottom, we saw the First Trust Enhanced Short Maturity ETF lose about $300 million. So again, not a lot to write about as far as ETFs go, but certainly it looks like investors on the ETF side, both on equity and fixed income, might have played this one right. So maybe institutional or smart money actually had it right this time. If we take a look at the muni bond fund universe, though, we saw that they actually took in money. This is the 5th consecutive week they've seen inflows, this time to the tune of $164 million. Second consecutive week, though, that they've actually had plus side performance, 0.31%. That's a good return, actually, for a weekly return from municipal bond fund. The dichotomy here is we saw national munis actually take in about $215 million. Told you that the inflows were 164, so single states obviously saw outflows. This is the 6th consecutive week, though, that national munis have actually taken in net new money. That takes us to our last segment, and that's money market funds. Money market funds saw the lion's share of net new money come into their coffers. It's the 7th consecutive week they've taken in money, $17 billion as investors park their money on the sidelines. How it broke out is we basically saw taxable money market funds taking about $15.4 billion. How that broke out, institutional investors injected about $12.7 billion, and we saw $2.7 billion go into retail money market funds. And on the tax-exempt money market side, we basically saw $3.6 billion in net new money come into their coffers as well. So obviously people at the end of the year are starting to take some concerns of what taxes might do to their returns and going to the muni bond fund side for, if you will, tax-free interest income. Well, that brings us to the end of our conversation, and basically some big news came out today. Maybe it'll change people's idea of what fixed income is doing. We saw that the non-farm payrolls jumped to 321,000 for November. That's a huge number. I don't think many people had expected that big of a number. I know they were expecting the upper 200s, but certainly not 321. And that could have some people a little bit fearful that the Fed's going to say, hey, the economy's tooling along really well. We're going to go ahead and raise interest rates really quickly. We'll have to keep on that. Another thing that happened today, and never did reach it, but we saw the Dow Jones Industrial Average flirt with the 18,000 mark today, certainly on those good news of employment. It really reached, I think it was 17,991, so never broke the 1,800 or 18,000 mark, but certainly was there. And, that just tells you that, people are, they're stretching, they're looking for new highs, and maybe even expecting a Santa Claus rally to happen over the next couple of weeks as well. So that may pan out. We'll go ahead and check that out with you when we have our next flows area. If you want to do a deeper dive in some of the areas that I did not cover, you can go to lipperusfundflows.com and actually check that out. If not, meet with us next week when one of our analysts will talk about the flows for that week as well. Well, until then, my name is Tom Rosine, wishing you the best in your wealth planning and creation. Thanks for joining me today.